All right, what's at stake here, Jeremy? We've got the NASDAQ and the S&P at record highs. Could this CPI report, could this shake the confidence that investors seem to have in this market?
What we've been saying is now becoming more about the jobs report than the inflation reports. We do think the inflation numbers are coming down. We do our own measure of CPI. When we did it last month, it was almost 100 basis points below the actual number. Shows you that housing and shelter is like a very key driver of the actual numbers. But the Fed is starting to talk about this, their dual mandate and the jobs numbers even more than the inflation numbers. So we think they're on track for sure for the 25, but you could make a good case that they should be doing the 50, even though only 10% of the market forecasts are suggesting that today.
So, Jeremy, I don't want to put words in your mouth, but it sounds like you feel fairly confident, at least, that inflation is going to come in line or maybe lower than the estimate. I want to bounce something off of you. This is from J.P. Morgan's Dubravko Lakos. He and his team put out a note. The title of it, "Some Caution is Warranted." They go on to say, with 6 rate cuts currently priced in by the end of 2026, we believe risky assets may be vulnerable at a time when tariff-induced inflation is starting to flare up, possibly restraining the Fed's forward easing path. The next risk event is the upcoming August CPI release, which is obviously later today. They go on to say short-term caution. So it sounds like you're taking the other side of this argument. You think it's going to be softer and the markets move higher.
Well, we think the trend is there is some tailwinds for cooling inflation with the shelter data that we track. But also the Fed should look past the tariff-induced noise. Like the Fed should be responding to a tax increase. They should be going for the underlying trends in inflation, and that underlying trend is in a better spot. There's already a lot of good things that could cool inflation. Productivity trends are going to be better. We see that as a cooling inflation trend, but also shelter is the key real input today, which is already on the trend down.
All right, got to talk to you about mega cap tech, especially after those Oracle results yesterday. Oracle higher in the pre-market again today, boosting a lot of other AI-focused names as well. We saw a lot of people worried about concentration risk. Do you think that risk has lessened or maybe even been taken off the table altogether after a performance like that from Oracle, where, again, it was 100% of the S&P's gains yesterday?
Yeah, that's been one of the hated big tech stocks. And it really, really shocked people how big the numbers were. I think if you think about the whole AI trade, like where are you in the full cycle? Is it extended or where is it? I've been talking with our team. We think maybe the third inning. Like you're still very early days for how AI is going to play out and how it's going to diffuse. And you've had some big winners, being NVIDIA as the key enabler. But we think it's going to broaden out. And we think part of the next trade is software. Software has been left for dead this year. One of our only funds that's negative on the year is a software fund. And we think that is really part of the next part of it, this AI trade. But we're big believers in the impact, long run for the economy, for the markets, for the stocks, and think there's going to be broader participation beyond just the chip stocks.
All right, ECB decision coming up later today. Again, the central bank over in Europe expected to hold steady. What's your view of Europe right now? We've seen some political turmoil in France, but Steve mentioned it's kind of bounced back when you're looking at the CAC. Also, kind of a ratcheting up of tensions in the Middle East. Does that change the investability of Europe right now, or do you see it as equally attractive? I want to give you your flowers on this one. You're one of the first people to come on the show and say it's time to really look more globally and outside the U.S.
Yeah, I'd say that trend, it started performing, but people haven't really, U.S. investors are still focused on the U.S. We haven't really seen money move in major ways outside. You saw some European repatriation. They're bringing their money back home. For sure, the defense stocks have been very top of mind, and they were very hot at the beginning of the year. It cooled off a little bit. We're still believers. This is not a short-term, few-month trade. This is the next decade trade, is the investment in European defense and infrastructure. So we like the broader theme of Europe. The valuations are much more supportive.
But you like defense a lot more than the broader indexes and things like that. You're saying be more focused on things like defense, like BAE Systems, things like that.
But also just the cheap stocks, the infrastructure investment in general, we support it for the broader markets and ecosystem. Defense is a top theme, but the whole broader European economy as well.
All right. Really quick, Jeremy, we got to get going. You gave us a pick. Generally don't get a pick right now, but it's the WTV. It's a wisdom tree ETF focused on dividends. Why is right now the time for the dividend play when we're seeing tech taking off? I mean, why would you want to go to what a lot of people would see as more of a safety play?
So this is a high dividend and buyback, actually even more on buybacks than dividends. So it's got a close to 7% shareholder yield. So when we talk about companies thinking their stocks are cheap, they're buying back 5% of their shares outstanding generally. And it's sort of that broader participation. It's not concentrated. It's more flat weighting. As you think about the AI story diffusing through the economy, these are kind of companies who will use it, but also think their stocks are very cheap. So
okay.
the defensive nature of that element.